Welcome students again to the commerce class. I am happy to meet you all. I am your commerce teacher. Now in last class we have completed unit 1 and unit 2. We are stepping to unit 2 chapter 5. So we have seen what is capital market and what are the meaning and definitions of capital market. Now in this class we are going on with the functions and importance of capital market. See about the functions and importance of capital market. So capital market has a crucial significance to capital formation. So it plays an important role for a speedy and economic development of our country. The significance of capital market in economic development is explained here. So what are the side headings? The first one is savings and capital formation. Second, permanent capital. Industrial growth. Ready and continuous market. Reliable guide to performance. Proper channelization of funds. Provision of variety of services. Development of backward areas. Foreign capital. Easy liquidity. So these are all the 10 side topics of functions and importance of capital market. So the first one is savings and capital formation. So we also know about savings. What is the word meaning savings? So they save the capitals. How do they save? By the individuals, corporate and governments. So let us see. In capital markets, various types of securities help to mobilize savings from various sectors of population. So in exchange, what it does, it helps the capital formation in the country. So through the country's capital formation, it is helpful. So savings of the capital for a country is helpful for the country's growth. Next is permanent capital. So the permanent capital is the existence of a capital market. Stock exchange enables companies to raise permanent capital. So the permanent capital remains the same. The stock exchange offers an opportunity to the investors to buy or sell their securities. It offers the opportunity to the investors to buy or sell the securities, while permanent capital with the company remains unaffected. So the permanent capital doesn't get affected through this process. So permanent capital remains the same. Next one is industrial growth. So through stock exchange, whenever they want the money, they can take for the expansion of the company or the industries. So for example, if they are planning for a project or expansion for a scheme, for that they have to have some funds. So through this capital they can raise the funds. So in this case, the stock exchange can help the industry's growth. So here also it states that the stock exchange is a central market through which resources are transferred to the industrial sectors of the economy. Ready and continuous market. If I want to buy a stock or securities immediately, it is known as a ready market. Or if I want to buy the stock in whatever time when I need it, so it is a continuous market. So ready and continuous market is possible through stock exchange. Here it says that the stock exchange provides a central convenient place where buyer and seller can easily purchase and sell securities. Investment in securities more liquid as compared to other assets. So this is the expansion of ready and continuous market. Reliable guide to performance. So in a company, how the company is performing, we can watch this through the capital market. How the dividend is, how the company's dividends are provided, and how the securities are sold, and in what position is the company is. So through this we can find out that it is valuable for us to promote our securities in this company or what, or for us to put the shares in this company. So thereby they promote efficiency. So the capital market serve as a reliable guide to the performance and financial position of corporate, thereby promotes efficiency. Next one is proper channelization of funds. So the prevailing market price, that is before self existing price of the market of a securities, and relative yield are the guiding factors for the people to channelize their funds in a particular company. So to look their funds, how the company is proceeding, how the company's growth is, to channelize all these types of things which they have invested in the securities and shares in a company. So this leads to effective utilization of funds in the public interest. Through proper channelization of funds, through correct ongoing of the funds, to check if the funds are going on with a proper. So in this case, this leads to the effective utilization of funds in the public interest. Provision of variety of services. The financial institution functioning in the capital market provide a variety of services such as granting the long-term and medium-term loans to the entrepreneurs. Entrepreneur is the person who creates the new job, who starts a new job by his own. Provision of underwriting facilities, assistance in promotion of a company's participants in equity capital. So provision is made. And the next one is development of backward areas. So the capital markets provides funds for the projects in backward areas. So where the economic development is not yet much there, so there the development banks also provides the amount or the security shares, that is to the economic. This facilitates the economic development of backward areas and rural areas. Next function is foreign capital. So capital market makes possible to generate foreign capital to change of currencies. Indian firms are able to generate capital funds from overseas markets by way of bonds and other securities. So the capital markets, the overseas are changed here is bonds and securities. Next one is easy liquidity. Easy liquidity means soon as in that first thing itself we saw the easy, we are getting easily when it is ready and it is continuous, in that format we saw. Same like this in easy liquidity, with the help of the secondary market, investors can sell off their holdings and convert them into liquid cash as soon as possible. This is secondary market ensures easy liquidity. So the secondary market ensures the easy liquidity. The next one is Indian capital market evolution and growth. So the period between 1947 and 1973 marked the development of infrastructure for capital market. In these areas, in these years only, the capital market were infrastructure. During this period, a network of development of financial institutions such as IFCI, ICICI, IDBI, UTI, ISFCs, SIDCs. So these are all banks which was established. So these banks were established. This is known as a financial institution which were established. So during the period of between 1980 and the debenture emerged as a powerful instrument of resource mobilization in the primary market. This is the Indian capital evolution and its growth. Next topic we see about new financial institutions. So a number of institutions of finance have been established to cater to the credit requirements of various segments of industry and needs. A brief outline about these institutions are given. The first one is venture fund institution, and the next one is mutual funds, and the next one is factoring institutions, over the counter exchange of India OTCEI, National Stock Exchange of India Limited NSEI, National Clearance and Depository System, NCDS, National Security Depositories Limited, that is NSDL, Stock Holding Corporation of India Limited, SHCIL. Welcome to Venture Capital. What is venture capital? A venture capital financing is a form of equity financing designed especially for funding new and innovative project ideas. So you can see a person who is known as Sam. So he want to bring up his company to higher position. So he has some new ideas, innovative ideas. He asks a loan from the bank, but it was rejected. Then he goes to another person, Sue, who invests $1 million in his fund, in his company, and he shares his become a shareholder. So the person Sam gives his Sue owns 60% and Sam owns 40%. So he creates an incorporation. So here we can see that however the Sam gets an amount from a capitalist. Here also one example is there, a venture capitalist, somebody who invests in a business venture. So here also same Sam is there, and the same Sam asks his loan from the bank and it was rejected, and he asks Auntie May for a loan, and because Auntie May is a very big and rich person, wants to invest, so the Auntie May has become a venture capitalist. So who is a venture capitalist? Who has much more money and wants to invest in a company or an incorporation or in a firm to become a shareholder for that company also, and he or she wants to know about the company's funding and its profits in later. Next one is mutual funds. Mutual fund is a financial institution that facilitates for challenging savings of small investors into avenues of productive investments are called mutual funds. A mutual fund company invests the funds pooled from the shareholders and gives them for the benefit of diversified investment portfolio and a reasonable return So the specialized financial institutions like LIC, Life Insurance Corporation, UTI, etc. Besides this, the commercial banks such as SBI and Canara Bank are also carrying out the business of the mutual fund. So the benefits of mutual fund is high return, easy liquidity, safety and tax benefit to the investors. So the high return, this and all comes from them banks, they give the LIC. Okay. What is factoring? Factoring is the sale of book debts by a firm, that is a client, to a financial institution, that is a factor. The financial institution is the factor, on the understanding that the factor will pay for the book debts as and when they are collected on a guaranteed payment date. So factoring is an arrangement whereby a financial institutions provides financial accommodation on the basis of assignment sale of account receivables. So the factoring institutions collect the book debts for the or on behalf of its clients. For example, some of the factoring institutions operating in India are SBI Factors, that is subsidiary of State Bank of India, and Can Bank Factors, so the subsidiary of Canara Bank. Next is OTCEI, expand over the counter exchange of India. Over the counter exchange of India. So it was incorporated in 1990 as a section of 25 company under the Companies Act 1956 and is recognized as a stock exchange under section 4 of the Securities Contract Regulation Act 1956. So it was set up to provide investors with a convenient, efficient and transparent platform for dealing in shares and stocks. So it is mainly for shares and stocks. So they give a platform for the enterprising who want to promote with a new project in their mind, their companies, to that they can raise their capital from the capital market with a cost effective manner. Next is National Stock Exchange of India, that is NSE or NSEI. The NSE of India is a leading stock exchange of India, covering 370 cities and towns in the country. So in country 370 cities it's covering. It was established in 1994 as a tax company, and it was established by 21 leading financial institutions like we have seen before itself: ICICI, IFCI, LIC, SBI, IDBI. So it is main feature for national wide coverage and ringless, that it has no ring or trading floors. There is a screen based trading. So there is a permanent screen based trading. They have a stock exchange place. So it is transparency. So to use for example, the use of the computer screen for trading markets, the dealings are security transparent. It is transparent for the investors, those who want to invest. Next one is National Clearance and Depository System. Under this, scriptless trading system, settlement of transaction relating to securities takes place through a book entry. So the following tradings are done here: National Trade Comparisons of Reporting System, which prescribes the terms and conditions of contract of the security market. So in between a company and everything, they have a contract signed. So it is clear that trading also they need a contract. And next, in National Clearing System, which aims for determining net cash and stock liabilities. And next one is National Depository System, where which arrangements are made provide the transfer of ownership of the securities in their futures by payment by book entry or electronic ledgers. So this is National Clearance Depository System. Next one is National Security Depository Limited. The NSDL was set up in the year 1996 for the achieving and the time bond determination as well as remetalization of shares. The establishment of NSDL is expected to abbreviate the problems of post-trade transactions in the secondary market, mainly for the post-trade transaction in the secondary market. And the next one is SHCIL. This is the symbol and logo for this: Stock Holding Corporation of India Limited. So they are serving as a central securities depositories in respect of transactions on stock exchange. The corporation also takes up the administration of clearing functions at a national level. Next, we are going to see about the foreign exchange markets. So the foreign exchange markets abets the foreign exchange trading. So it is the largest, most liquid market. Liquid means soon as possible we are getting the money on hand in the world, with an average traded value of more than 5 trillion per day. So per day they are making more than 5 trillion. It includes all of the currencies in the world, and any individual company or country can participate in it. So it is a foreign exchange market. We have seen the national stock exchange markets there. It is overall the foreign exchange market. Next, we see about what is commodity market. The commodity market manages the trading in primary products. Before we have seen all about the secondary products. Now we are going to see about the primary products, which takes place in about 50 major commodity markets, whereas financial transaction increasing the outstrip. So the physical product purchases which are to be delivered. So in commodities it is a physical products which we can see. So here you can see a picture which shows about the commodity markets where we buy and sell commodities, that is cattle, pigs, coffee and corn, soya beans, sugar, metals and oils and many others. So the history also is given there about the commodity market. So it was started in the 19th century in the United States. The next one is the two types are classified, or commodity classified into two subgroups, that is hard commodity market, and next one is soft commodities. So the hard commodities are raw materials typically mined such as gold, oil, rubber, iron and ore. Whereas the soft commodities are typically grown agriculture products. So soft commodities are agriculture products and hard commodities are raw materials to bring up as a product. So what are the soft commodities here? The primary products like wheat, cotton, coffee and sugar. So the hard commodity are non-agricultural commodities and the soft commodity are agricultural commodities. Next we see about the derivative markets. Derivative markets facilitates the trading in financial instruments such as future contracts, what the contract will be in future, what we are going to contract in future, and options used to help control financial risk. The instruments derive their value mostly from the value of an underlying assets that can come in many forms like stocks, bond, commodities, currencies or mortgages. Okay, so we have seen all these things. What and all we have seen? We have known about them. What is the meaning of OTCI? What is the expansion for it? And we have seen the foreign exchange market. We have seen the commodities, hard commodities, soft commodities. So we have completed our lesson. With which one? The 5th chapter. So thank you students. Kindly go through it.